And welcome everyone to another Smart Money Circle update. I'm Adam Sarhan. With me today is Claire Smith, who's CEO of Beyond Investing. She has a very interesting product. The ETF is for vegan investors. Ticker symbol is VEGN. The two websites are www.beyondinvesting.com and then veganetf.com. Claire, thank you so much for taking the time and welcome to the Smart Money Circle.
Thank you very much. It's a great pleasure to be here.
So Claire, I always like to ask, can you tell us a little about your story and how you got to where you are today, please?
Yes, certainly. So I guess my financial industry career started in 1985, actually. Initially, I spent a short period of time at Chase Manhattan Bank going through the credit program, but then decided that I didn't like corporate banking. Mainly at that point, I was in the oil industry, in the petroleum department. So I was not particularly enthused about lending money to oil companies even then. And then I moved to jobs in sort of dealing room and then marketing and structuring products. And that was for companies which all became UBS at the end of the day. I then spent about 5 years doing independent consulting. And that was a shift towards the hedge fund industry. Because I was doing contract work for funds of funds and for also some press work at that time. And that got me noticed by my next company, which was Allborn Partners, that hired me in 2004. I worked for them until 2017, and there I was the primary analyst covering strategies within the quantitative and volatility spaces. So really based around the work that I'd done in investment banking, where I'd primarily been in convertibles and equity derivatives. And then I guess towards the latter part of that um, sojourn at Auburn, I became more and more interested in sustainable investing, which was actually um, a personal interest in terms of sustainability and the environment. Um, Most of my adult life, as soon as I became aware of the impact that commercial activity had on the environment.
Right.
And so I tried to embed, in terms of going forward, those personal interests and convictions into my investing career. And that's how I ended up founding Beyond Investing in 2017.
I love that. So you decided you almost went from the dark side to the light side, if you will.
Yeah, I
Nothing
know. Poacher turned
real.
gamekeeper.
And then you saw that there was an opportunity for vegans specifically investing, and you launched the vegan ETF, again, VEGN. So can you tell us a little about the investment strategy and what you do at Beyond Investing, please?
Yes, certainly. When you say I found that there was an opportunity and also a real need, because until our ETF was launched, there was no actual vegan investment strategy in place and available for people to buy as an investment product. And that was something that I found um, irritating and frustrating when I was trying to manage my own money. And I'm thinking particularly of a pension fund which dated from the period of time when I was in the investment bank, which I took over the running of, and then found it was very difficult to find funds that were actually going to comply with the concerns that I had. So um, through my personal experience there, and then talking with one of the fund managers that I knew very well, whose name is Larry Abele, who was running a quant fund, and then joining together with another gentleman called Lee Coates. So we're the three founders. Lee had been doing ethical screening since the late 1980s, in fact. We've put together the investment process in order to combine the animal exploitation screens, which Lee had been developing for some period of time because he was an advisor to animal charities in the UK in terms of their investment pools. We combined that with some other screens that were around the environment, primarily around fossil fuels, other types of environmental damage, single-use plastics, human rights screens as well, because we are just as concerned about humans as we are about animals. and developed the list of what are called in the prospectus prohibited activities.
Okay.
So if we find that a company is involved in these activities, then we exclude the company. And so the basis of the program is primarily this negative screening. So getting rid of companies that conflict with those principles.
Okay, that's interesting. So when you go through, I know you have an index and you have screens. Can you speak a little about that to educate the audience about how you structure it now or how you create?
Yes, of course. So yeah, so the screens, as I said, are in these broader categories. We exclude weapons and defense as well. I'm just trying to think if there's anything I've missed. So within animal exploitation, we've got the use of animals' sort of body parts, as it were, their physical um, um, the physicality and what they can turn into when they've been killed, as I suppose is what you might say, and then animal testing as well. So using them throughout their life, but also captive animals too, um, and uh, and uh, and once we've got to this list, generally when we are screening, we find, and we've done this in the US markets, we've done this in Europe, in global and international markets as well, we generally find that we're actually getting rid of about 50% of the stock market
Oh, wow.
through the screens. Yeah, so
Wow.
we are very fierce on our screening.
Mhm.
And as a function of that, then we have to put together a portfolio in such a way that it still provides sufficient diversification. And primarily that involves us reducing significantly some of the holdings of the top stocks.
Okay.
So we're all aware in the US market, there's a handful of stocks which are significant in size. And
Mhm.
if you take out 50% and then you basically want to invest 100%, if you didn't do anything, then those top stocks would immediately pretty much double in size and
Right.
everything else. But it's particularly an issue for the larger stocks, but they would get too concentrated. So we apply a risk spreading algorithm across the top, generally sort of 20 to 30 stocks. It's actually a function of it's actually a function of stocks that are above, would actually be above 1%. We're then spreading those risks out so that there are no stocks which are going above 4.5% when we rebalance. But then after that, if they do outperform, then they could go up over 5% or even higher. But then we trim back on the next rebalance when we do the algorithm again. And that allows us to provide a portfolio which is not going to be overly volatile and overly subject to the price performance of certain individual stocks, which obviously would increase the volatility of the portfolio.
I love that. So you have multiple layers. You don't want a stock or one position to get too big in the portfolio.
Yeah,
So you do some initial trimming, but after it's trimmed initially, you'll give it room to run because, like you said,
yeah,
the performance is very narrow and you want to own those leaders as they go. So
that's true.
yeah, and you've also your performance has been fantastic. So congratulations to that because what you're doing is working clearly.
Thank you. Thank you. There is something which is a very, very small component of the portfolio, which I did not mention up until now, which is that we do have an amount, it's less than 1% of the portfolio, but we do go down into the mid cap in order to find some stocks which would replace those that we screen out. So we would have some plant-based stocks. We would have some renewable energy stocks. There are some other sectors as well where we end up underweight sometimes in materials or industrial sectors. And so we do go into the mid cap and do some additional screening on those stocks to see if there's any of those that we could promote into the portfolio. So this again is also an additional diversification and also something which helps with the risk, because obviously if you are screening on the basis of animal derived products, for example, you're going to end up with almost no exposure to consumer staples,
Right.
because that's, animal products are in every clothing company, every supermarket, all of the
Makeup, all
food
that stuff.
manufacturing.
Right.
There's no sizable vegan food manufacturing company. So we do delve into the lower portions in order to try and address those underweights.
Yeah, so this is a good, I guess, segue to the next question, but you've already spoken about is how
Mhm.
do you handle risk, and what are some mistakes do you see people make with respect to risk management? So well, if I understand you, Claire, correctly, on the upside, you do the rebalancing and you make sure the position doesn't get too big, but at the same time, you want to have a healthy enough position so when it does run, it adds alpha or adds value. How about on the downside? Let's say you buy something and your thesis is just wrong, stock goes down. Are you looking to buy more, or are you looking to sell it with stops, or how do you handle that side of the equation?
We wouldn't make any changes to the portfolio between the rebalances, but obviously, if the stock was still eligible at the next rebalance, then we would look at it again. But we would apply the same algorithm. And outside that risk spreading at the top, the algorithm is primarily market cap weighted, because what we're trying to do is to provide people with an alternative to the market benchmark. So
Okay.
S&P 500, which is the sort of bellwether for the US market.
Hmm.
So for us to then apply something that was a dramatically different weighting scheme
Right.
would cause much more tracking error to occur. And so we genuinely want to be able to say, this is how we've performed versus the S&P 500.
Got it.
And every change that we're making in terms of A, the stocks that we're choosing, and B, our weightings are valid, but are not intended to kind of game what we're doing. They're intended to be a realistic and appropriate and prudent way of running a portfolio on a long-term basis. We're not from one 6-month period to the next.
Okay, wonderful. I wasn't aware of that, so thank you for clarifying. So just like if the S&P 500 or the Nasdaq 100 has a stock that goes down a lot, it doesn't just kick it out right away. It'll wait for the next rebalance and decide. How often do you rebalance?
We're rebalancing every 6 months.
6 months. Beautiful.
Those, yeah, they take place in June and December, early June and early December.
I
Mhm.
love that. And then next question for you, Claire. What are some timeless lessons you've learned along the way that you'd like to share with the audience, please?
Well, I mean, I think the value of what we're doing is consistency and sticking to our premise. Um, the consistency, as I said, in terms of the screens and in terms of the algorithm, the weighting scheme that we're using, and our premise really is that these are not just activities that we dislike from a personal standpoint. We can create a thesis around why we should be excluding these stocks from the
Right.
perspective also of their future earnings. Um, we see, for example, in terms of the fossil fuel companies, the pressure that they're on to change their business models, the fact that there are you know there will have to be controls on how much fossil fuels are burnt in order to prevent further warming, and the fact that at the current time, quite a large amount of their market cap is based on the reserves that they have in the ground, despite the fact that it's not actually reasonable or sensible at this stage to be pulling those reserves out of the ground and then selling them. We see the same story around the animal products companies. So companies that are breeding animals, rearing animals, etc. They're getting under more and more pressure. People are conscious of their methane emissions. People are conscious also of the pollution, and there've been some very high profile and very expensive lawsuits, for example, where meat companies have polluted the air and the water of local communities and even further downstream and into the main waterways and in place and where people may be getting their water from. So those are potential lawsuits, so reputational issues, cost issues, and then ultimately regulatory issues that will hit those companies because of the nature of their activities, the damage. A
Mhm.
thesis around animal testing. Animal testing is primarily used by pharmaceutical companies and
Mhm.
biotech companies in order to do research, test drugs in the preclinical. That actually is a cost to their business because the animal models, as they call them,
Mhm.
don't provide very accurate results. In fact, most of the companies that get through the animal phase don't work on humans, something like 94%, as I understand. So those companies need to be changing their business activities in a way that doesn't use animals. And at the moment, they're, notwithstanding that they have been quite profitable, their profitability is actually, and it's an additional cost to them to be using these animal models. So
Interesting.
those are just a few examples, but you could basically construct a case that these are to some extent broken business models, because they are either doing something in a very inefficient way, or they're doing it in a way where they cannot continue because of the kind of excess damage that they are doing, and so ultimately they will be hit.
So you're
You
saying
can also create a sort of demand-led aspect to it as well, in terms of changing behavior of consumers towards sustainability. But I think it's both a push and a pull.
I love that. So you're saying from the timeless lessons there would be number one, stay consistent. Number two,
Mm.
make sure that you have a thesis or an investment framework that resonates well with you and that you can continue to stay with it. So you don't have that style drift where you focus on the next shiny object or this or that when yours is out of favor. And then make sure that you're aligned with it so you do know that you can stay the course and over the long term, hopefully things work out well. Is that a good way of summarizing it?
Yeah, I think it is, and bear in mind this is a very long-term thesis. I mean, for example, there's been reports out from leading consulting companies like A.T. Kearney, Boston Consulting Group, around the fact that a significant portion of the meat market will shift towards alternatives in the next 5, 10, 15 years. So in some sense, it is a very long-term thesis, but we're comfortable that we're moving in that direction, even if there is a bad year for the strategy, and actually 2022 was a weak year.
Mhm.
um, was because of some very specific, well, global and macro style of impacts in the market around oil price, around interest rates rising, etc. And then ultimately last year we had our best year. So immediately after that poor year in 2022, there was this massive rebound in the strategy, which was obviously very good to see. And it was our best year since inception.
Well, congratulations, and hopefully 24 is going to be better. So let's talk about some timeless mistakes. You've been in the business since for a long time, so for decades now, and you've stayed around. So clearly, you know you've seen some people exit the business. What are some timeless mistakes you see people make in investing or trading or anywhere in this world, and how do you recommend they avoid them?
Um, in terms of mistakes, I think you can. Well, we always used to say in the old times, in the city, always leave something for the next man. And I think that in terms of selling, discipline, I think you can sort of overbelieve your thesis sometimes. And so when you do see extremely good performance from a strategy or from a stock, you do have to look at it again and say, you know, is is the market kind of getting high on this stock, as it were? Is it overvalued? Are people projecting far too far into the future, and not discounting all of the things that could potentially go wrong with a stock? Has this stock or sector been hyped too much? So I think that that's really where people sometimes make mistakes, is by staying with positions for too long, not being prepared to take a profit. So notwithstanding, obviously, that the performance has been strong in the last year, it has been our best year. Um, I'm not telling anybody to take a profit on vegan, but certainly one has to be conscious that the market does shift one way and the other. One example that I was really thinking about when I said that was in the plant-based market, which
Mhm.
got very, very overbought in 2021. after a run up, I suppose, from 2019 and a huge number of stocks which came to the market, sometimes some very small stocks which had not achieved profitability, but they were taking advantage of the excitement that there was around the space then. Evidently, we've seen that sort of flatten off a little bit in terms of the growth. It's still there, and there's still a long-term argument in favor of the shift, but clearly those stocks were very vulnerable to a reduction in sales or a reduction in the growth that they were seeing, because the growth that had been priced into those stocks was quite extreme. And I remember looking at the pricing of Beyond Meat, in the first year or so after it came out, comparing that with Tyson and seeing how different the pricing of the two was. I think Tyson was trading on about 0.7 times revenues, whereas Beyond Meat at a certain point was trading at 70 times revenues.
Yeah.
Which seemed really extraordinary at the time, especially for somebody who, in terms of the hedge fund area, I'd always been involved in arbitrage.
Right.
So
Right.
that definitely felt wrong. So yes, so don't believe the hype too much. Be aware when there is a hype, and always try and find some kind of cross references that you can make just to kind of check where the valuation is of a stock. And if you do that, then I think you can avoid some mistakes.
I love that. And then how about, Claire, the best piece of advice you'd like to share with the audience or give your 30-year-old self?
If I was going to give this advice to my 30-year-old self, I'd actually give myself advice to take more risks, but take more calculated risks, and be aware that diversification is the only free lunch. So if you are taking a lot of small bets, that can be a safer approach, even if those individual bets in themselves might look quite risky. That can actually be a safer approach and a more ultimately better long-term approach than concentrating in some a smaller number of stocks where you feel that you're not necessarily taking as large bets. I mean, examples of that might be, the banking crisis that we had last year, for example. Those stocks looked very safe for a long period of time, and they were perceived as as some of the most exciting or interesting stocks in the banking space. But they they ultimately, despite being in major market indexes, they did just get wiped out. I think you can afford to take a lot of smaller bets, and then let some of those bets run. Obviously, do stops, etc., if things are not turning out right. But that ultimately could be a better longer-term approach than being fooled by the size of a stock to think that it is a low-risk stock.
That makes perfect sense. Well, Claire, thank you so much for taking the time to come on the show today. People can learn more by going to beyondinvesting.com or veganetf.com. Once again, the ticker symbol is VEGN. And hopefully, Claire, we'll speak to you again soon. This has been fantastic.
Thank you very much. I appreciate it.